Amit Kumar, are you able to see the screen?
Yes, I can.
Okay. So yeah, I'm very excited. So let's get started. So I believe more right now the times are so uncertain. There are layoffs and there are uncertainties going on. So um, I think that's part of the economy. That's a cyclic curve which happens every 10, 15 years. It happened in 2008, and right now there are certain sectors which are booming. There are not enough people to work, and certain sectors where there are layoffs, and so I believe that's part of the cyclic economy nature. So I hope I can give you guys some comfort in terms of where to start from. So today's agenda. So what we'll be talking about is the 6 steps of financial independence, and then we'll covering some financial concepts where we'll be talking the value of time and the power of compound and simple interest. And then we're talking about some financial planning tools available in this country. And I believe most of the session I will be spending more time in question and answers. So my intention is to finish the presentation in another, hopefully a 45 minutes to 1 hour time. Feel free to drop your questions in chat or unmute yourself and ask. I'm okay with that. I might take that question at the end if I feel that it might distract the audience, but definitely those questions will be entertaining. So starting with the financial independence. So generally what financial independence has got a different definition for each of us. In this part of the world, a very common thing is if you ask anybody by what age you want to become financial independent, and they will say 55. 55 is a very magic number in this country. Everybody wants to stop working for themselves for money. So what's the definition of financial dependence is? You stop working for money. You still work, but money is not something which is driving you. You do it because you love it or you want to keep yourself busy, but you don't need to earn bread and butter. And that's what the financial independence is. Now, yeah, you might want to retire, live back in Mexico. That's your choice. But to as a basic financial independence is becoming debt free. So basically you don't need to worry about paying mortgages and debts, and you have enough income coming that your incoming and outgoing is kind of matched up, and you don't need to worry about where your bills will be paid from. So what is the first step for that? So first step is cash flow. Obviously we need money to save money to make money. And the first tip what I learned is doing the budgeting. I don't know how many of you guys do the budgeting on a monthly basis, but first thing is to manage your expenses and yeah, maybe on additional income. So first tip I will give you is start budgeting. If you have not budgeted, now what do you mean by budgeting? List down your monthly expenditures, starting from a Netflix subscription to every recurring expenditure on a monthly basis. And there will be certain expenditures which you plan to do on an annual basis. You might not have a fixed number, but start rounding off that number and put that number and then divide it by 12. Make a spreadsheet and start developing a monthly budget expenditure. And this is a very good start, you will notice, and then kind of do a reconciliation at the end of the month or a couple of months. Okay, your budget was $5,000. Did you end up spending 6,000, 7,000, or you were below the budget? And that will help you make yourself conscious about where your expenditure is. And that's the first place to start managing your expenses. Second step is consolidating debt and striving to eliminate debt. So now, I don't know, many people. So first thing, when you come to this country, everybody advises that get a credit card and start building your credit score. Getting a credit card and building your credit score is very, very important. However, many people does not know how to use the credit card, and they start taking high interest debts, and the credit card interest debt can be 24% per annum. And depending on the card, it might be compounding quarterly. So that means you end up paying a lot of credit card debt. Sometimes you take some personal loans which are not very cost efficient, and you end up paying a lot of interest. The interest rates in this world is low. However, in last 1 year, we have seen the interest rates have been going shooting up. Right now, I believe the prime rate is around 6.75%. So if you take a personal line of credit, it will be bare minimum at somewhere around 8 to 9% or 10%, the unsecured line of credit. So it's very important to consolidate that. And what happens? If we miss out a payment, we have to pay a penalty, we have to pay some fees, and we end up paying double the payment what we had to do. So one of the ways is to consolidate this debts, and there are ways and means in this country available to how to consolidate it. And then you start eliminating the debt. And that's what I call it the snowball approach. So what happens is if you have a debt, you have a car loan, you paid that car, and then you have another education loan. And let's say your car loan is ending up in 2 years. Your education and loan is ending up in 6 years. Once you finish your car loan, you assume that your car loan repayment is not completed, and you continue to repay the debt at the same value. That way you will finish up paying your education loan faster and not the other way around. So try to eliminate the debt. It's a consistency what is needed for that. Third thing is emergency fund. Now, most of us over here are on PR, and that's a good thing. Once you are on PR, you get some credit from the banks. So first of all, we need to have an emergency fund, and ideally it should be around 3 to 6 months. But many people don't have this kind of savings. So what to do? Go to the bank. If you are a new immigrant just coming to the country, you are on PR, generally you will get a good line of credit. If you are employed over here, they will at least give you up to 1 month to 2 months of your salary, a line of credit. And that's where your emergency fund can start. Now, what is a line of credit? It is just like a credit card, but it has got a simple interest. So credit card might have a 24% compounded interest, whereas line of credit might have a 10% simple interest. So that way you spend a lot less, and that line of credit is only utilized if you use it. Otherwise, there's no interest charge on it. So that will help you give little bit of peace of mind and take care of some unexpected expenditures and help you for that emergency. Next thing is having a proper protection. So now, once I start making money, I need to make sure that I am protecting my income. If I buy a phone, I am protecting a phone by taking some kind of an protection on that phone. So similarly, with our income, with our family assets, we need to have proper protection so that if my income is affected, at least my foundation is secured and I don't have to worry about my retirement plans or my long-term investment plans. And we'll talk more about these concepts further. And last thing is building the wealth. How do you build wealth? So it's simple. First of all, you need to outpace inflation. That is, right now, if the inflation is 6%, then we need to outpace it. The money has to at least grow at 7%. Then I'm outpacing it. Reduce taxes. How do you reduce taxes? You have control now on reducing taxes. You won't have control after that money is invested in some kind of an account for 20-25 years. So what kind of account to invest in, we have to think now. And then we have to think about tax preferred growth. That means how much growth I'm getting and whether it will be a taxable growth or a tax deferred growth or a tax preferred growth. So we'll again talk about these tools in the further line items. Okay, so what's your relationship with time? When it comes to finances, it can be your worst enemy or it can be your greatest ally. How? So let's take an example of power of time. So we have an example of Mr. Save Early and Mr. Save Later. Let's say a person is saving $2,500 a year until the age of 65 in a product which gives an annualized return of 8% per year. What are we getting? A person at the age of Mr. Early, at the age of 30, starts saving 30, at the age of 30, starting saving. How much principal he invested? He invested $87,500 because for 35 years, he will be investing it. And how much the principal grew? To almost $500,000, to almost $450,000. Now, what happened to Mr. Save Later? He just started saving 5 years later. 5 years is nothing, right? there was a difference of $12,500 he saved. That means he saved around $75,000. The money which grew was around $300,000. What happened? The difference is almost around $150,000. So this is the power of time. And what is happening? It's a compounding of the money which is happening. Mr. Save early got the advantage of compound interest, whereas Mr. Save later was at a disadvantage because he didn't started saving early. Most of us, what we do? Oh, right now I have this commitment, that commitment. The moment we have something in life, we stop, we put a break on our investments, on our finances. And that's what happens. We kind of delay our financial independence. So now this is a X curve. This is a very important slide. What is a financial timeline over here? So when we are young, we are generally less secure and we are building wealth. So we don't have much of savings. We don't have much of income also. Our income is low. Slowly we start getting experience and we start getting good at our work, and that's where our income rises. And then we start building wealth. However, the liability is the highest. We have mortgage, we have rent, bills, debts, all kind of liabilities are there, but our risk is low. That means the illness, death, and injury risk is less. That's when we want to start building wealth. What happens as we grow older? The responsibility decreases, and ideally the wealth should increase. But now what happens? If I don't focus, if I was the Mr. Save later instead of Mr. Save early, what happens? I will have not enough money for my retirement, and my risk will be higher because now I have a higher risk of illness or some kind of an issue, health issue. And also, if I have invested some money somewhere, there will be estate preservation which will be required. We'll talk about estate. I think most of you might not know what is an estate over here. We'll talk about what is an estate. And that's where it becomes very important how to use the money in tax efficient way. So the questions you want to ask is, when you are young, when you are just starting to grow your income, are you and your family protected? And are you setting aside some money for your retirement, so that we don't end up where we have less wealth and more responsibility when we grow old? Okay. So this is one more example how time works for your financial well-being. So this is $1 million. $1 million is a magic number, right? Everybody loves a millionaire, want to be a millionaire. The first thing when I bought my townhome, I called my parents, said, Dad, I'm a millionaire. I never dreamt of being a millionaire in India, but finally in Vancouver, I became a millionaire. Why? Because I bought a house which was around that. So that was my first dream. And I believe everybody wants to buy $1 million house, which is kind of a necessity out here. You don't get anything less than that in lower mainland. But let's talk about $1 million. If I have 40 years of time to invest, then I only need to invest around $670 a month. If I have 5 years of time to invest, I have to invest around $15,000 a month to become a millionaire. Now we are talking about where we are investing in a 5% tax deferred account. So this is the power of time. We start early and we save more. We start later and we have to put more money to do the same thing. So rule of 72. This is a very powerful rule. This was given by Albert Einstein. He termed it as the world's 8th wonder. And it's basically, it's like he who understands it earns it, he who doesn't will pay it. So let's understand what this rule of 72 is. So a rule of 72 is how much time you have to double your money. We all are from India. Generally, we say that, oh, if I do a fixed deposit in India, they say that, oh, it will double in 7 years or double in 10 years. That's what my parents used to tell me when I was in India, when I was younger. It's the same thing. So what is happening? If I have a 4% return, then I have to divide 72 by 4 it will take 18 years to double the money. So if I invest over here in a GIC, a guaranteed income certificate, at the age of 29, I invest $10,000, it will double at the age of 47. So at the age of 65, I will have $40,000 while double. If I'm investing money at the interest rate of 8%, then my money will double every 9 years. And I'm investing at 12%, my money will double every 6 years. So this is the rule of 72. So we spoke about making the first million. We spoke about Mr. Save, Mr. Early, or Mr. Save later. They are all the rule of 72 is coming into play. That's why start saving early. So now we came to this beautiful country. One of the things over here is why is the need for retirement planning? So first of all, over here, the healthcare system, the overall weather, everything is good, and hence the mortality age is much higher. Like the average age of Canadian or average age of North American is around 85 years. So there are longer lifespans. And that's why there's an increasing health cost. Even though MSP is free, the aftercare is not free. The long-term care is not free. There's a lot of aging population. And government is not able to catch up with the government benefits to service this aging population. So many people used to earlier rely on government, and that's what, if somebody is coming from India, they will say, oh, okay, government will take care of us when we are here, and that's why we're taking the PR. That's no longer the case. Government is not able to catch up with that benefits program. The cost of living is rising. Everybody knows over here, buying a property in Vancouver is becoming costlier day by day, and the returns are declining. And that's why we have the need for retirement planning. So let's talk about the traditional pillars of retirement. Like generally, if we see a lot of people out here, the old age people, if you talk to them, they didn't invest in a lot of different pillars of retirement. They generally dependent on 3 pillars, which was personal savings, social security, and company pensions. So let's talk about social security out here. So first of all is Canada Pension Plan. So if anybody who is employed or who is receiving a salary, when they do that, the employer will deduct from their paycheck a Canada Pension Plan contribution.
Did he take the controller without your permission from your room?
Is there a question?
You see? Why did I?
Hello? Okay. So when in the monthly paycheck or bi-weekly paycheck, what you'll receive, you will see a deduction called CPP. So this is a mandatory deduction regulated by CRA, where employer will pay a contribution and the employee will pay a contribution. So average amount over here right now, if you contribute till age 65 for 40 years, the average amount what right now a person gets when he retires is around $727. And the maximum amount can be $1,254. And this is a taxable income. Second thing is old age security pension. So this is somebody who has stayed in Canada for 10 years, they will be eligible for this pension. And they have paid CPP up to a certain extent. So the maximum amount for 2022 payout is $687 a month. And then if you are in a low income group where your income is less than $25,000 a year, then you are entitled to old age security benefits, which is called GIS and allowances. And the minimum allowance you get around is $600 and maximum is around $1,000. So this is for the 2022. Other than that, there are employee-sponsored pension plans. So generally, if there is an employee-sponsored plan, if you see, you will have DPP or DPSP or RRSP pension plans. You will when you get your benefits package, and that's where what happens. Employer will match up to certain contribution. So if you say that, oh, I have a pension, just like in India we have PF over here, that is similar to the pension plans, like Provident Fund, and basically it might be 5% match up or 3% match up. There might be certain union jobs where there might be 8 to 9% match up. So those are the employee sponsored pension plans. And the last thing is personal savings and investments. Okay, so these are the traditional pillars of retirement. And let's see now, and now we call it a broken stool. So now this pillars have kind of, if you don't focus from it from the start, then what happens if I invest too much in RRSPs, my CPP, my OAS gets affected. If I invest too much in the pension plans, it's again a taxable income. So the moment I invest too much in a taxable income plan, my investments in long-term retirement planning get affected. So it's a game of math. And that's what we talked about earlier, that in order to save taxes, we need to think about where should I invest right now, if it's a tax preferred tool or not, before I start investing in it. So now let's talk about the personal tools, savings and retirement. So this is the most important thing. There are, I'm seeing the Canada has got one of the best tools in system over here for investment. So first thing is the RRSP, which probably everybody is aware of. The deadline is 1st of March. Second tool, which is being launched in May 2023, it is a tax-free first home buyer savings account. And third one is one of the most powerful tools in Canada is TFSA, tax-free savings account. So these are purely on the investment side. Second thing for personal savings is life insurance. So again, through life insurance also, you can have permanent plans like universal life and whole life, where you can create your own bank. So that way you can take loan from your own plan, and that, while you are in the age of retirement. Third thing for people who are having kids, one of the very good plans is registered education saving plan. It is for the postgraduate education of students.
This is actually a very good plan. I invest for my family. I have been doing this for my own daughter since these, right? I think you'll go into more detail of this later, right?
Yeah, I will be going into more detail of it. Yes.
Yeah, this is something which is very interesting for your kids and all the stuff.
The next thing, when we kind of exhaust this first three buckets, the RRSP, TFSAs, and life insurance and RESPs, then we get into the non-registered investment. Now you might be wondering what the hell is registered versus non-registered. Whenever a tool is being directed by CRA, regulated by CRA, there will be some contribution limits, some dime limits. It's called a registered plan. When it is not regulated by CRA, everything is regulated, but when they are not dictating the terms, it becomes a non-registered investment. And then we have the investment property. So again, investment property is also a non-registered investment. But yeah, most of the people want to buy 2, 3, 4 properties to create a passive income. And that's where it becomes an investment property. So RRSPs. So what is the primary goal of RRSP? It's a registered retirement savings plan. The goal is primarily for retirement. Now the contribution is around 18% of the earned or gross income. However, there is a limit. So maximum contribution can be $29,000. So if somebody is having an annual income of $200,000, they cannot just contribute 18% of $200,000 because it will be around $36,000. They will be capped out at $29,000. The purpose is to reduce the taxable income. So what happens the moment I do some RRSP, my taxable income drops immediately. So if my income is $100,000, I do $5,000 of RRSP, my taxable income is $95,000, and that's how I save tax. However, it's a tax deferred growth. So eventually that money gets invested, and the plan is right now we are in a high income bracket. And when I retire, my income will be low. I will be in a low income bracket, and that's where I will pay reduced taxes. So government is trying to force people to save money for the retirement and incentivize that, saying that, okay, when you retire, you will have lower taxes. So it makes sense. You can pay a little bit of less tax, and you will have some money saved for yourself. Now the withdrawal is taxable. However, if there is a first-time homebuyer program or a lifelong learning plan, so if you are buying your first home, you can withdraw up to $35,000 if that much contribution is there in the RRSP. Or if you want to do your master's for yourself, like some education, you want to study, then you can withdraw money without any tax liability at that point of time. And then there is a, like in installments, you have to pay it back or it gets added to your income. So for the first time homebuyer program, the maximum limit is $35,000. And how it works is you contribute to RRSP, you keep it in the RRSP for 90 days, and then you can withdraw from the RRSP for your first time home buyer. So if you're buying a home, you qualify as a first time home buyer, you can withdraw that money. So you take the initial tax advantage, and later on, you have 15 installments to pay that back to the RRSP. If you don't pay it back, then every installment that gets added to your income. So if you withdrew $30,000, one installment will be $2,000 per year. So if you don't pay it back, then $2,000 get added to your income. So this is a very powerful program to avail RRSP savings.
I think
If you don't do enough, yeah.
if you can give a good example, this would be awesome. Yeah, like how they can do this. Like
Yeah, I was thinking of maybe doing a little bit of math later on, because now again a new program is also getting launched, right? The first home savings account program. So yeah, what I can do is later on I can, or maybe I can do it right now. I can.
Yeah.
I will have to join the Zoom. I will join my iPad also. Can you let my iPad in?
Yeah, sure. You guys feel free to ask questions, guys, if you're like this thing. This is like two-way session. If you guys have any questions, you don't understand anything, we can probably go into more detail and explain that.
So I have a question.
Sure.
So, Mr. Amit Ajmera, so you said about this RRSP thing, right?
Yeah.
I just want to understand like the difference between a TFSA and an RRSP, because right now I'm putting money in the TFSA, but if you are not like into like with the intention of buying a home right now, and you don't invest in RRSP, is it like recommended to invest in RRSP as well, or investing in TFSA is a good long-term investment?
It's a very good question. So I will park your question for a little bit, if you don't mind. What's your name? Sorry.
Dishant.
Dishant. Okay. So I will be covering TFSA after this, and eventually RRSP and TFSA, it's all a game of math. Okay. So if your income is in a high income bracket, and you are able to save money by putting in RRSP, then it might make sense. But I will go into a couple of examples to show you whether RRSP makes sense or not. Otherwise, investing in TFSA does always make sense if RRSP is not the right tool for you. Okay. Yeah.
Okay.
So it's kind of, there is no yes and no answer to it. It's always subjective, depending on what is your income and what is your life goal. Okay, so if your life goal is to buy home and you are in a high income bracket, then maybe RRSP will make sense. Okay, but now there is another twist in the discussion. Now a new program is being launched by the CRA, which is first time home savings account. If you want to buy house again, which is a combination of an RRSP and TFSA, which also I will be talking about. So let me first just cover the first time home buyer program, how it works. So let's say now there is a person, his income is $100,000. Okay. Now that person has got a down payment of around $30,000, let's say, okay, to buy the house. What they can do is they can first of all, first of all, if I'm doing, if I do zero RRSP, okay, then I will be paying tax at around 28.2% marginal tax rate. So I will be paying tax around $28,200. Okay. Now, if I do 30,000 as a contribution as part of the first time home buyer program, what happened? My taxable income dropped down to $70,000. So this is my new taxable income. I put money into the RRSP for 90 days, and then I withdrew it for my down payment. Okay. Now this $70,000. So what happened? The $30,000 multiplied by 28.2%. It's approximately $9,000 I saved in tax. Okay. So now earlier I had $30,000 for down payment. Now I got $39,000 for down payment. Now what I can do, I can use this $9,000 for down payment, or I can use this $9,000 maybe to invest back or to do some home renovations. So now I took the control of this $9,000 in my amount. If I was not doing anything in RRSP, this would have made total sense for the first time home buyer program. Okay. However, there's a good thing to learn about is the marginal tax rate. So generally first time home buyer program always makes sense if somebody has got taxable income, because you save money, and later on what happens? I have got 15 years to pay back. Now I borrowed $30,000. If I don't want to put it back in RRSP because I'm in the lowest tax bracket, my income gets, and if I make $100,000 every year, if I don't pay it back, I will have $2,000 extra added to my income because I didn't pay my installment on RRSP first time home buyer program. And I will be paying tax on this $2,000, which is nothing as compared to the overall. So it makes sense to do first time home buyer program always. But now there is a new program which is getting launched again. So I will also talk about it, which kind of gives more flexibility to the end user. So always, so again, if your income is $60,000, doing RRSP does not make sense. But just for the sake of first time home buyer program, maybe it might make sense. Okay, because eventually you will still be in the lowest tax bracket. So what is RRSP doing is it is not in future you have to pay the taxes. Either you pay the tax now or you pay the tax in future.
So yeah, so it works on a policy called EET, that's exempt tax, which means that it's exempted at when you invest, it's exempted at growth, but it's taxable when you take it out. So that means that whenever you are going to take out this money in future, you will have to pay taxes on it.
Exactly.
Amit, I have one more question. This is Sandeep. So this is more like a fringe question, but if usually what I know is that CRA taxes you on worldwide income. So if you're not actually contributing to the RRSP here in Canada, because you don't have an employer here in Canada, but somewhere else, can you still contribute to the RRSP?
Are you, yes, so.
No, I don't think so, no, because RRSP is calculated based on 18%, maximum of 18% based on your last year's income.
Exactly.
If your last year was 0, then you cannot do anything this year.
But yeah, I just want to know the definition of income here. That is it worldwide income or is it only in Canada income? Because taxation is generally on worldwide income per CRA. So I'm coming from the US, so that's why I wanted to know.
So once you will file tax over here, once you have your notice of assessment, Sandeep, whatever is the income on the notice of assessment, CRA will automatically give you a RRSP contribution room. Okay. And up to that much you can invest in RRSP. So if you came this year, you cannot contribute this year. But when you file the taxes this year, your income gets generated. Then after that you can contribute. And again, you can take advantage of the tax benefit.
I think it's a very good question. I would assume since you are showing your worldwide income into your income tax over here,
Yeah,
it should calculate. But this is, I think, it's a more of a chartered accountant question.
Yeah.
I
Okay.
would be 100% sure, but I feel it should be
Yes.
included because you are actually showing your worldwide income into this thing, and you are like, you may, if the taxes that you paid earlier in whatever country you was that was lower than the taxes here, then you will end up having
paying the difference amount here.
Yeah. Right. So you're actually paying more tax over here. So I think you should be eligible. But to be very, very sure, I think this is a accountant question rather than.
CPA question.
Okay, yeah, this is a French question. I understand.
Yeah,
So
yeah.
okay, yeah, that's
This is a very
Can
good
I share
question.
something?
Yes,
Hi.
sure, good.
So I came to Canada in 2020 September, but I didn't start working till January 2021. But so I filed tax for 2020 based on my Indian income, and I had a limit on my RRSP for 2021 based on my Indian income.
Yep.
okay.
Yes, if it qualifies as an income in Canadian context, then yes, next year when the notice of assessment gets generated, but yeah, whether it's an income or not, that the CPA will define that particular story. But once that income is there, the RSP contribution is there, you are good to go. You can contribute.
Okay, but looks like if the income is being reported for the previous year, then you get a notice of assessment. Then the
Yes.
next year you can contribute into RRSP, right? You can't.
That's how
do it-
RRSP works. You need to file first income, and then only your contribution room gets created.
Okay.
It's
Okay.
different from TFSA. TFSA, if you came this year, you can start contributing this year. But RRSP is different, right?
Okay, got it. Got it.
So I have a question, Amit. So like regarding, as you said, like it depends upon the income, like in Canada, like as you said in RRSP, if you're earning anything less than below 100K, for example, right? It you think it doesn't make sense to invest in RRSP as you said, but you can invest in an alternate program called the first time home buyer. Is that what you think?
No, no.
First time home buyer is part of RRSP. What I'm saying is, and I will be discussing one example, one math. Basically, it's a math equation. You should do RRSP or not is a math equation. Okay, and
Okay.
that's my next. So maybe let me share that, and it will give you a little bit of more clarity. Okay.
Okay. Okay.
So let's say this. Let's take this example. Okay. Income is $80,000 at the age of 35. Okay. The marginal tax rate is 28.2%. You contribute 10,000 to RRSP every year. Now, your lowest marginal tax rate is around 26%, but most of the people will fall under the 28% marginal tax rate bracket between $80,000 and $100,000. Okay. Your total contribution, because every year you are doing IRSP, $10,000. Your total contribution is $300,000 in next 30 years. Now, how much tax did you save? 300 multiplied by 28.2%, you saved around $84,000. Okay. You invest this 6% at 6% rate of return, and then your monthly income 5,000 for next 20 years. Okay. How much RRSP did you got? $60,000. Now, what is your RRSP income? 5,000 you will withdraw every month. So 12 times 5, 60,000. Plus your pension income, so around $85,000 you got as your annual income in retirement. Again, you ended up paying the same amount of tax. Okay. So for high net worth individuals, it makes sense to RRSP because they are at a very high income tax bracket. If somebody is having $150,000, they are at around 48% tax bracket. So it does make sense. But again, what are you doing with that? See, just doing RRSP and putting the money in GICs or whatever is not going to help. What are you doing with that? Are you putting that refund back in investment or not? That's a question. I did this. Let's say what I can do is I can do RRSP. I can save tax. If the tax what I saved, if I put it back in TFSA, which is a tax-free savings account, my growth is non-taxable. So
yeah.
yes, you can do RRSP, but what are you doing after that RRSP?
So
That's
again, I'll just give one more quick thing over here. TFSA works on a TEE. Sorry, remember I told about RSP works on EET, exempt, taxable. TFSA works on TEE. It's a taxable it's a taxable money that you invest into TFSA, and it's exempt at growth, and it's exempted when you are taking the money out. So any growth that you got, all is tax free, right? So you already putting the money you're putting in TFSA is already taxable. That means you have already paid tax on it. So any growth that you get on that money, which is when you're invested in TFSA, is exempted, and when you take that money out, including the growth and the principal, that's also exempted. So you remember this EET and TE, right? And both of these TFSs and RRSPs are buckets. Remember this, they're buckets, right? They're not actual programs. So actual investments are like GICs, which is equivalent to fixed deposits, or mutual funds, or stocks, investment stocks. These are actual this thing. So all RSPs and TFSs, you can invest in either GICs or mutual funds or stocks. Okay, there is certain limitation on RSPs, what kind of stocks you can put in, all stuff, but that's a little bit more detailed. But overall picture is that you can say, okay, this money I'm putting towards TFSA, but TFSA, you can choose it to put into a fixed deposit, or you can put it in a mutual fund, or you can put it into stocks, those kind of things. Okay, just to clarify. So these are not actual programs. So, you can't say, okay, I want to go into TFSA. The next question your banker will ask, okay, TFSA, fine, but where do you want to invest your money? Do you want to keep it as a fixed deposit? Do you want to put it in a mutual fund, or do you want to invest somewhere else? Okay, just
yeah. So another question on that lines, because I see the contribution limit in TFSA is like, I think it's 6,500 per year, if I'm not mistaken.
Yeah.
Right. So is that like
that? Okay, sorry, just to correct, I think Amit, you want to take that on?
Yeah, so I wanted to listen to his question first. I wanted to listen to his question first, then I will answer.
Sorry, I'm like literally new in this market, trying to understand.
No, totally. That's what we are here for, right? You can ask any question. There's no stupid question. Everybody, most of us are new. They don't know anything about that. There's no right or wrong question. Just go ahead and ask whatever is in mind. That's the whole purpose of this section, is that you understand the basics of everything.
Correct. Thanks, Amit. So what I was trying to ask you is that, since I believe I think initially the limit was $6,000 per year under TFSA as a contribution limit. My only concern here is that if we are putting the money only in TFSA and not RRSP, right? So is it like we are allowed to put only like $500 per month, or more than, like, because we cannot max out, right? The limit in a year. So is that like we can only put like up to like $500 per month in your TFSA, and then how the money can multiply, or we can add more money every month in TFSA to increase our savings?
So if CRA gave you, so basically this year your TFSA limit is 6,500. Previous year it was 6,000. Okay, and that limit does not expire. If you came this year, then you only have 6,500 to contribute. You can contribute it in 1 month, or you can contribute in equal installments or at your own pace in 12 months. That's your call. But you cannot contribute 6,501. You can only contribute 6,500. Now, if that money grows and become 12,000, no problem. But you can only contribute 6,500.
So give a little bit of history about TFSA. I think TFSA started after I came to Canada.
2008.
When I came to Canada earlier, 15 years back, that there was no TFSA. They introduced like around 10 years back or something like that. And then, if I remember correctly, the first couple of years, the investment per year was $5,000. then they increased to 5,500 at some point of time, then they increased to 6,000, now 6,500.
Yes.
Okay. Now, what has happened is the one beautiful part about it, TFS is, as Amit said, there is a maximum. This is how much you can invest in a year. But if you choose not to invest, let's say for reason, let's say you didn't have money 6,500 this year to invest at all, or maybe you just invested like, let's say $1,000, right? So the extra room, $5,500 that remains, you invested $5,000 this year, 5,500 gets rolled over to next year. So let's say government next year says, okay, you know what, your maximum limit for this year is $7,000. They increase it by another $500, let's say. So next year you can invest $7,000 of the next year plus $5,500 for the last year. So that means you can invest up to $12,500. So if you came to Canada this year, and the very important part is if you came to Canada this year, that means that this year you can only invest 6,500. But if you came to Canada last year and you have not invested any money, right? So last year limit was 6,000. This year limit is 6,500. So this year you can actually invest up to 12,500. So that gets rolled up from the day you came to Canada. Somebody, if you have been somebody like me, like 15 years here since the RRSP was introduced, TFSA was introduced, and you have never invested in TFSA, you probably would have a limit of $50,000-$60,000 you can invest.
$88,000.
$88,000.
So that's what is in my screen right now.
Amit, I would like you to include that any access of TFSA, there is a penalty or not.
Yes.
I think folks need to know that.
In both. If you invest anything extra in RRSP or TFS than your limit, there is a penalty, and that penalty is pretty big. So don't do that.
Yeah.
So you have to be very, very sure about your limit before you invest anything into both of these programs. Thank you, Salesh. That's absolutely correct.
No, just give an example. I actually paid $2,000 penalty to CRA for by mistake putting in money in TFSA above the limit.
Yes. So yeah, you don't want to do that. You have, before you invest, make sure you know your limit, and then only you invest after that. Don't do anything before that.
So the best
How do we know?
you go to your notice of assessment. The notice of assessment will show the limit, and that's your best bet. Now, talking about TFSA, so basically how it works is after tax dollar goes into this account. So again, this is a vehicle. In that, passenger can be anything. Passenger can be a GIC, a mutual fund, a stock, an equity, or something which is allowed by CRA. Okay.
Amit, I will like to add here, the limits of RRSP and TFSA are also listed in the My CRA account. When somebody submits the tax, they get a My CRA account to log in and check. So it is there in the bottom section, which says, please see your RRSP and TFSA limits.
Yeah. Very true. So yeah, if the maximum contribution room, if somebody is in Canada since 2009, is $88,000. So the biggest advantage of this account is it does not impact your government benefits. And if you are not able to invest this year, you can invest next year. Your limit does not expire. Just like RRSP and TFSA also, your contribution limit does not expire. So whenever you have some money, you can put it into the account and it carries forward. And yeah, your OAS, your CPP, all those contributions does not get impacted. You might create $1 million portfolio in TFSA, and that $1 million will not be counted as income for the taxation purposes. So this is a very powerful account. But most of the time, people think that it's a tax-free savings account. So if I open an account, I will start saving tax. So we need to understand what is tax-free. The growth is tax-free. If I'm putting money into it and it is giving me 2% return, there is no growth over there. There is no tax-free in that. So TFSA I want to utilize for growth. Okay. I will go back to RRSP because there are certain more features to RRSP than just the first-time homebuyer program. In this, there is one more feature called spousal RRSP. Now, many people are not aware of this particular tool. So what happens is, if I am a working individual and my wife is not working, she is a housewife, so she does not have income. So what I'm allowed, or maybe she has an income, but it's a very low income. What I'm allowed is I can contribute in the name of my wife. I will get the tax benefit. So how it works is uh, at the later age, since my wife was not working, she will have low income, and that's where we can take better advantage of our government benefits. The government benefits are peanuts, but we still want to take advantage of those benefits. So if we do it using the spousal RRSP, then it might make sense. Again, yeah. So what happens is in spousal RRSP, you contribute for in your spouse's name, you get the tax advantage, but after 2 years, that income becomes your wife's income. So this is also a very good tool. People do use it for first-time home buyers program also. And yeah, there are multiple ways we can use the spousal RSP and do the tax planning. One important thing is don't die with too much RRSP. There is an exception of spousal rollover, but otherwise, let's say if I kept investing in RRSP for 30 years and now I have got a $500,000 or $1 million portfolio. If the money gets rolled over to my spouse, no problem. There is no tax eligibility. But if I don't use that money and even my spouse dies, 100% money becomes taxable in the same income year. So I get taxed at highest tax rate, which might be 50 or 55%, and I end up paying half of my money to CRA. So yeah, RRSP is a double-edged
You
sword.
don't get taxed. Your kids who will inherit that money will get
Yeah, yeah.
and you will end up paying a huge estate tax on all of the. Yeah, that's where
So
state
it's a
planning comes in.
double-edged sword. Yeah. We don't want to do too much RRSPs. Okay, without doing the math on it. Yeah.
Yeah, because I have a personal experience to share. So Amit, basically when I moved to Canada in 2019, right, and I immediately started to put my money in our TFSA, right. So I started with a small amount, but for the past 2 years, and because the recession is in North America, right, especially in Canada now, so I'm looking at my returns now; they're going in negative in TFSA, right.
Yeah.
So I just got to know from people I don't know. I mean, I was just doing some research that in banks right now, the banks are giving better interest rates than the interest you earn from TFSA, right? The return that you earn from TFSA. So
again,
is it?
So that's the thing. I'll let you take Amit. You can take that.
And maybe Dishant, I would request I will be showing a slide on it, and it will help you understand what is an account and what is invested in that account. This is just an account. TFSA is just like a checking or a savings account. Okay. It's nothing more. Why?
Yes.
Remember, I spoke of registered and non-registered accounts. So when we say TFSA, it's a registered account because over there CRA defines, oh, the contribution has to be only 6,500, blah, blah, blah. They give a definition of it. So it's just an account. In that you can use, you can invest in a mutual fund, you can buy stocks, you can buy a Tesla stock under TFSA. Okay. Or you can invest in a fixed deposit, which is called GIC. Or there are several other investment tools available. Okay. But TFSA is just an account. So it does not matter. Let's say you today opened a TFSA account with Wealthsimple, and tomorrow you open a TFSA account with RBC. Those are just financial institutions who are opening the TFSA account. Later on, what are you doing in that account matters. Are you investing your money in a high interest savings account, which gives you a 3% or 4% return, or a 5-year non-redeemable GSE, which might give you a 6 or 7% return, or you are going into a mutual fund or a fund portfolio, which might have an annualized return of past 10 years of 10 or 12%, or you might be buying a Google or Microsoft stock, which might give you in 20 years of return. So it's all different. Okay. Yeah.
Yes. So I was trying to complete by saying that as from my experience, I was looking at it, I've invested in I've created a simple a basic portfolio on TFSA, right? And as you said that it can invest in mutual funds and it can invest in other stocks and everything, but the TFS does it on your behalf, right? You're not sometimes buying it on your own, like they buy it on your behalf, right?
No, they don't buy on your behalf. So what happens is that I'm assuming by what you're saying, I'm assuming you have put in some kind of a mutual funds. That's when you say
mutual fund.
it's going in negative, that means that you have invested in mutual fund. Now, and the rules of mutual fund apply, right? Then you tell them, okay, this is my growth strategy. Like I want to put my money 80% growth, 20% debt market, or 90% growth, 10% debt market. I want a more balanced fund of 50%.
Right.
50% debt market, 50% growth, right? So the more growth equity you choose, the more riskier it is. Then there is a possibility of it going down when the stock market is down, right? So you tell your mutual fund company that this is what my investment strategy is, this is what I want to do, and they buy stocks based on your instruction. Like so if I okay, so for example, if I'm saving my money in my TFSA for my retirement, then I'm okay with even in short term stock market goes down, like in 2-3 years stock market goes down, my investment goes in negative, I'm fine, because I know in 20 years when I retire, the investment, it will all recover and I'll probably be getting more returns in mutual fund. But if I'm saving money into TFSA to buy a house in next 1 or 2 years, then putting your money into TFSA in TFSA mutual fund may not be a great idea, because if a price goes down, then you are actually losing money. Now you don't have down payment, right? So you would rather than you will probably go into a say like high savings interest account, or maybe a GIC, right? So you will have to take what is your objective of your fund, and based on that you have to invest.
And we will be talking more about it, Dishant. Okay. Yeah.
Okay.
So next thing which is coming in the May 2023, Canada just launched is the tax-free first home savings account. So basically this account is nothing but a combination of RRSP and TFSA. So this is purely for a first-time homebuyer perspective. So there will be a contribution limit of $8,000 per annum. So starting 2023, when we can open this account with any registered financial institution. Okay, again, this is an account. It is not a fund or something. It's just an account. I can open multiple accounts, but my contribution can be maximum $8,000 in a year. And what it allows me is, the moment I contribute to this particular account, I can take the tax advantage, just like RRSP. However, when I withdraw the money for the purchase of first home, I don't need to pay money back. So if you look at the first-time homebuyer program, I withdraw from RRSP, I'm obligated to pay that money back to RRSP. Otherwise, it will become my taxable income in 15 installments. In first-time home, first home savings account, you are not obligated to pay back, and that will not be added to your income again. So the maximum cumulative contribution room is $40,000, and let's say if you, and it remains for 15 years. So you have 15 years to save in this particular account before, and if, let's say after 15 years you couldn't buy a house, then it will go back to your RRSP, and it will be converted into your RRSP account. So this is a very powerful tool which is launching, and every individual should plan on taking advantage of this if you are planning on buying your first home in Canada.
So
Again,
is it launched, this program?
In May 2023, it will be launched.
Okay.
So in another 3 months, it will be launched. Okay. So again, this does not reduces your capacity on RRSP. You can still take the advantage of the first-time homebuyers program. This is an additional tool over and above the first-time homebuyers program in the RRSP. Okay, so these are two different accounts we are talking about. Next is RESPs. So as Amit Kumar said, this is one of the very parent-friendly accounts. These are available in Canada. So again, this is a registered account. That means CRA has established guidelines. The goal of this account is for children's post-secondary education. That means once my kid completes grade 12, they go for college education.
Amit, your slide is showing tax-free from 7 points. For me, at least.
Is it?
Yeah, it's fine now.
Is it fine now?
Yeah.
Okay. So over here, how it works is, government, basically what happens is when we contribute in RESP, we can do maximum contribution of $50,000 in over the end up to the age of 16. And after that, government will match 20% annually for the first 2,500 contributed. So basically, government will contribute $7,200. So if I contribute $2,500 this year, so my child is right now 5 years old, I have started contributing $208, which is $2,500 a month, a year. Government will pay me $500 extra. So I contributed 2,500. Government paid me 500. So now there's a $3,000 which is being invested for my kid. And this will continue. Government will pay maximum 7,200 towards this grant. Now there's an additional grant. It is only for BC, not for Ontario, which is additional one-time $1,200 grant, which is called Technical Education Savings Grant. When if I have started my RRSP in the age of 6, government will automatically give me $1,200 in my RESP account. Okay. And what happens is the best part about this account is we can utilize this money towards kids' education. And even though this money is taxable, generally kids will have low or no income when they are studying in college. They might be doing some part-time job, but they will have tuition credits and all that stuff. So even though it is a taxable income, they will end up paying 0 or no taxes. So so that way you can almost say it's kind of a tax-free account, but it's not tax-free. It is a taxable account, but kids will have how much? $20,000-$25,000 income. That's nothing. And so you invest in this account, let the money grow, use the grants, use the growth, and in future you can pay for your kids. So what happens is it's a small amount you start contributing. You contribute around $50,000 and you have put into an account which gives you at least good returns, 7-8%. That will help you accumulate for your child's education. So this is a very powerful plan. Every person should think of putting in money into this plan. And the earlier you start, there is more growth available. Later you start, you can still catch up with the grants. So at a minimum, you should take advantage of the grants, and more you can have a tax advantage growth on this particular plan.
Yeah, I invested for my daughter the day she was born.
Yeah,
literally the day she was born. So yeah.
So one thing to consider is, if somebody is on work permit and their kids are not born in Canada, then they cannot invest in this plan. The person has to be permanent resident or a citizen in order to, they need to have a SIN number. The kids need to have SIN number to invest in this account. Okay.
So this account, like RESP, you're talking about, so you can open this account with any institution, right? And then you are saying that invest the money. So is it kind of like we have to manage this money, like we invested and then we have to put different mutual funds or stocks, or the bank is going to manage it?
So yeah,
so
there are multiple options available. Most of the times, I think there are certain platforms which allows you to invest also. I'm not sure about it. Generally, it is in funds or directed funds. It might be in GICs or funds. So most of the financial institutions will allow you to open this account. But one important thing you have to take care of is there are two kinds of RESP plans. One is a group plan and one is a self-directed plan. Don't invest in a group plan. A classic example, there is a company called Knowledge First. If you have invested, or if you are investing in Knowledge First, it's a group plan. There are also some banks which offer a group plan. Like if you are an employee of that bank, they will offer you a group plan. What happens? There are enrollment fees and there are management fees. So almost up to 1 year of your contribution goes to enrollment or management fees. So you want to go for a self-directed plan. Now you can open this plan anywhere in most of the financial institutions. And it's a registered plan, so there is nothing to worry about. And there are different, again, this is just an account. So the moment you open an account, you contribute $2,500 a year, you get the $500 grant. So your contribution and grant is taken care of. What we are worried about is the growth, or what we are discussing is the growth. If it's a self-directed plan, you are invested in something which just gives GICs, okay, there is 3 or 4% growth. But if you have invested in, let's say, some kind of a funds, it might give you better growth. Okay. But if you have invested in a group plan, from your contribution, your money will be again deducted. So make sure you're not enrolling in a group plan, you're enrolling in a self-directed RRSP. Okay.
There are a couple of questions, Amit, in the chat.
Let me check. Yeah.
So I think Yogesh has asked, in case of family RSP, can the more money is used to can the more money is used towards one child than the other? Say let's say 70% towards one and 30% towards the other.
Yeah. So let me, first of all, most of the people will not know what is family RSP. Okay. So in a self-directed plan also, sorry. In a self-directed plan also, let's say you have 2 kids. You can open a family RSP. So you are contributing for both the kids. If right now I have 1 daughter and 1 son. Earlier my daughter was born and I did RESP. And now my son is born, I do another RESP. I opened the account together and I said I want to do a family RESP. So I'm taking advantage of the grants. I'm getting grants for both the kids. And I'm allowed to use that money for 1 kid. And I think that's what Yogesh's question is. Yes, you can prorate it. Most of the time, why people do family RESP? 1 kid will say, I don't want to do higher education. I have some other plans. I want to open my business or whatever. You can use that entire money towards the education of the other kid. There's no problem in that. Yeah. And the government contribution, yeah. So, and how it works is you first withdraw the grant before withdrawing the growth portion. Again, that's something your advisor should advise you. If I am doing an RSP, I will make sure that I am requesting the withdrawal of grant first. And later on, I am requesting the withdrawal of contribution in the growth. So you use up the grant first of all, because sometimes what will happen, your kids will get full scholarship or whatever, and they will not need that money for education. In that case, you first use the grants and then rest of the money. The only clawback which happens is the grants. And if you use that grant, then there is no clawback. Okay, investments. So I think Dishan, this is again, this is somewhere it might help you a little bit of more clarity of what's going on with investment. So there are 3 No's of investment. First of all, knowing yourself. What is your goal? Oh, I want to save money because I want to buy a house in 3 years. It's different from I want to save money so that I can send my kids for education. It's different from I want to save money for my retirement. So what is your goal? What is your timeline? 1 year, 2 year, 5 years. Many people I have seen, oh, I have got some $5,000 spare this time. Let me invest and get some return on it. And then the market tanks and we kind of lose money on it. That is called emotional investing. The biggest risk, we call it FOMO also, fear of missing out. Oh, right now everybody is investing in Tesla. Let's buy Tesla. It's at $78. And by the time you start buying Tesla, it's at $200. That's a fear of missing out. So never do emotional investing. Know yourself, first of all. What is your goal? What is your timeline? And don't invest your emergency fund. Most of the people, they do, oh, I have to get married next year. I have saved around $30,000 for my marriage. What to do with that money? Let me put it in some stocks and all that, and I will get some good money out of it. Yeah, you are lucky. Then that stocks will grow in 1 year by 30%, but it might go down by 30%. So know your timelines. When you need this money, accordingly choose your investment. And third thing is the risk tolerance. Some people are good if the market fluctuates by 20-30%. But some people lose their sleep when the market fluctuates. So you need to understand your risk tolerance. Everybody's risk tolerance will be different. There are no good or bad investments. A good investment for one person will be a bad one for other one because their risk tolerance is different. So while you are discussing with people, generally what we do is we do very offhand conversation. अरे यार कोई fund बता जो बढ़िया वाला है. Now, बढ़िया वाला fund can be anything. For somebody, if the volatility is low but it gives a 6% annualized return, they are happy. For somebody, volatility is high but it gives 12-15% return, they are happy. So please know the risk tolerance. Second thing, know your investment. Is it right for you? There are a lot of tools available in this country, lot of investment opportunities available in this country. Understand it. Is it right for you? People just invest without understanding the product. Somebody invests in a non-redeemable GIC. Now they don't know what is a non-redeemable GIC. They want to buy a house in 2 years and they invest in a 5-year non-redeemable GIC through RRSP. And now they go and say, I want to withdraw that RRSP. You can't. It's a non-redeemable GIC. Your money is stuck. And then you end up fighting with bank to try to withdraw that money. So you need to know your investment, what kind of product you are investing in. And third thing is knowing your advisor. Unlike India, over here, government does not regulate 35 million population. They regulate handful of advisors. So what government says, I am not going to take the headache of dealing with so many people. I am going to crack a whip on these advisors. So it is advisor's goal to give you the right direction. And over here, you will need more financial advice. And similarly, if you go to house buying, you will need a realtor advice, or for mortgage, you will need a mortgage advisor. You will need these services from time to time. So you need to know those advisors. You need to develop that trust. Just like you need to have a lawyer and a doctor in your kitty, you need an advisor in your kitty, because many times you will start emotionally investing, and that's where things will go wrong. So the advisor will bring objectivity to your investments, to your financial goals. And where the moment you are in a little bit of a debt situation, you will try to pull out all your investments. And that's the wrong thing to do. There are always ways and means available to navigate a circumstance. So have a trust in your advisor. You find an advisor whom you trust, and then check that advisor out. If you build confidence with them, work with them. And that way you will be able to, slowly you will be able to gain some good information, good knowledge, and you will feel better about it. Now, types of investments. So if you can see, it's a simple slide. So all these RRSPs, TFSs, RESPs, tax-free home savings account, this is a car. And in this, all these are different passengers. It can be GICs, GIFs, high interest savings accounts, funds, stocks, equities, bonds, money markets, REITs. These are all passengers. So again, Darshit, right? Or if you're talking about an account versus where you invested, account is just an account. In that, where you're investing is a passenger. So what is your goal? This account is a vehicle. Now, if you want to go from Vancouver to Kelowna, this car will take you. Or from Vancouver to Banff, this car will take you, depending on where the passenger wants to go. Okay. So make sure you are keeping. So many people, most of the time I ask to people, hey, where are you investing in RRSPs? They will say, oh, I have an RRSP account with RBC or Scotia. Well, that's just an account. Where are you investing? And they don't know most of the time. So you need to know what your passengers are. Where are you investing in it? And then you need to know what kind of rate of return are there, what kind of product is it, and what kind of growth opportunities are there. So you need to ask these questions to understand the product. Next thing is securing your foundation. So I don't know how many people understand this, but let's say we are building a home. What is the first thing we do when we build a home? We first of all build a foundation. And we build a foundation, we do anti-termite treatment and all that stuff to make sure that my foundation is not infected by pest and my home remains secure. When I'm doing my financial planning, we are talking of RRSPs, RESPs, TFSs, everything. They are investments. And you can only do investment when you have secured your home, you have secured your foundation. And that's where this insurance plans comes into play. Now, I know in India, insurance is a very negative word. The moment we talk of insurance, people shy away. And over here also, we'll take insurance for every small thing. But when it comes to life or related insurances, we think it is an expense. So what kind of, but it is not. Again, if we know the product, if we know the need, then it is not an expense. So let's talk about life insurance, critical illness, disability, health, and dental plans. So life insurance can be used for multiple options. It can be as simple as just for an emergency fund or a college savings, or it can be for living benefits, for estate planning, for retirement planning, for tax reduction, like tax deferred growth, or it can be a working capital account for businesses. So life insurance has multiple ways it can be used. And the type of life insurance, so there are generally two types of life insurances. One is term plan. We call it a rental plan. And second is permanent. So what is a term plan? Let's say I'm right now staying in a rental property. I'm having a 2-bedroom condo. I'm paying $2,500 a month rent. It allows me to stay for every month. The day I stop paying my rent, I will be evicted from that condo if I'm on rent. Same thing is a term plan. If I have a short-term liability, let's say I have a mortgage. I got a mortgage for 20 years. I need to protect my mortgage, because if I'm unable to pay my debt because something happens to me, if I die, then my family will have to either sell off the house or the bank will take the house from me. In that case, I need to protect my mortgage. So what I do, I can take a term plan to protect that short-term debt. Or I can also get a permanent plan. It's like owning a house or a property. So we talk about estate planning. So let's say if you will buy a house tomorrow, and you might buy 2, 3, 4 houses as investment properties. When something happens to me and my house is passed on to future generations, there will be a capital gains taxation liability on that. And CRA will ask for the money. And many times these permanent plans, one of the ways you can use the permanent plan is to pay off that estate liability. The other way you can use this permanent plan is like be your own bank, where you can take loan from these plans when you retire. You won't get a retirement loan. So this permanent insurance can be used to take a loan from your bank other than protecting your life. So many times this question comes to me whether I should buy my employer offers me insurance. I would like to go through them because generally the group plans are damn cheap as compared to the individual plans. So there are few things to consider. First of all, what happens is with group plans, tomorrow my employer might change the group plan benefits provider. Today it's Manulife, tomorrow it might be Sun Life, and your coverage is gone. You have to start again. Second thing, your health is not locked. They don't do medical underwriting. Whereas you buy your own plan, you do a medical underwriting, your health is locked, your age is locked. So your premiums remain constant, they remain level. Whereas when you buy through a group plan, every year premium will increase, and one day you will lose that group plan because you might be laid off or you switch a job, and that's where you lose your coverage. Third thing is, generally you are not able to decide how much coverage to take by yourself, and that's where you end up getting maybe twice of your salary or something, or you get some kind of discount. That's it. And you cannot do portability. Okay, your plan is tied to the group, so every time you change the group, you need to reapply. So that's why many people tell me, hey, I've got a big life insurance through my work. I paid extra and I got an extra work life insurance. It's still not good because you are not locking your age and health. So if you're buying a life insurance, it is advisable that you buy from your individual pocket, and consider that the group insurance, what you have is a cherry on top. You don't consider it in your financial planning. Critical illness insurance. Many people don't know what is critical illness insurance. So in Canada, medical healthcare is free. But what is free? It's generally most of the procedures are free and some of the drugs are free. But most of the drugs, when something happens like heart, stroke, bypass, cancer, most of the drugs, you need either your extended health plan needs to pay, or you need to pay from your own pocket. And 1 in 4 Canadians get some kind of a major illness like heart, stroke, bypass, or cancer, and almost 1 in 2 gets a cancer. So that's why critical illness is getting a big deal in Canada. You see a lot of GoFundMe pages going on, requesting this kind of contributions. And most of the people don't have critical illness insurance. And most of the employers don't offer it. They offer around $10,000 to $15,000 coverage. So what this does is it covers major 25 illnesses. And if you get diagnosed something, you receive a tax-free lump sum payment. And this also helps for your long-term care planning. So you can use it as an income replacement for medical expenses. So what happens generally when something like this happens? First of all, I am not able to go to work. I lose my income. Plus, my spouse has to stay home to take care of me, or I need to hire somebody to take care of me. And that's where there's a higher outgoing and a less income. That's where this kind of insurance comes into play. Disability. Most of the people who are into work, generally they get, and they are into gainful employment. They do get disability insurance from their employers. However, if somebody is self-employed or somebody is a business owner, they don't get disability insurance. This is basically a paycheck protection. So it protects you from unexpected illnesses or accident, and you get around 60 to 70% of your monthly income, and sometimes up to 85%, depending on your net taxable income. And it is useful when you temporarily can't work. Generally, 2 to 5 years is the term which is pretty popular in Canada, but it can be also for permanently disabled people. And last thing is the health and dental or extended healthcare plans. So it's usually provided by the employers, and it is recommended that if you are getting an employment, you negotiate these benefits with your employer. Because if you go, you can also buy for yourself, but if your employer provides it, it's a subsidized plan, and that's where you portion of the cost is paid off by the employer, and that's where you need to pay less. But if you are a business owner or self-employed, then you might have to buy the benefits by your own, and it will help you cover the expenses which are not covered by MSP, which is primarily medical, dental, vision, and other medical expenses. Recently, Canada has launched some benefits programs. Again, it's a socialist economy. So if somebody's income is less, family income is less than $90,000, and you have kids who require some dental work, then government is providing some reimbursement up to a few $100s to help the families. last thing, but not the least, the most important is estate preservation. So what is an estate? So let's say if I have two houses, if I have a bank account, I have got RRSPs, I have got TFSAs, I have got some open investments where I have invested in some stocks or something. My RRSPs and TFSAs has a beneficiary, no problem. My principal residence, it gets passed on to my spouse rollover, no problem. But everything outside of it gets into your estate. If I have bought two houses as investment property, that's my estate. If I have my own business, I have a pizza store or a gas store or a gas station, that becomes part of the estate. So what happens if I don't have a will? It does not automatically pass on to my family. The government will appoint a probate officer. They will do the due diligence to make sure that we don't have any debts owing to somebody, or somebody does not have a claim on our business or our property. And once the due diligence is done, that's where that money will that asset will be passed on to our family members. And what happens? This comes at a cost. Probate officer is not free. Probate officer is going to do that job, and the bill is going to be paid by you or your family. That's why it is very important we do the estate preservation. How do we do that? It can be done through a will or a living trust, and it will decide your future legacy and assets. So let's say what goes to my children. Let's say I get medically incompetent. I'm not able to take decisions for myself for some operations or something like that. It can be mentioned in the will, and those decisions can be taken by my family members. If I will not do it, court will do for me, and they will charge money for me. And sadly, in Canada, only 42 to 50% people do estate planning. Even the white Canadians who have been here forever, it's not necessary that they are doing the estate planning. But more importantly, people like us in India, will is not such a big deal. But in this part of the world, get your will done. Will is not costly. It can be done either free through many online resources or at a very minimal cost. You don't need a lawyer or something like that to do a will. Most of the wills are pretty simple, and it can be easily done. It is extremely important for families with minor children because, yeah, even you're like with minor children, you need to define their custody. So all these things are required. So get the estate planning done. So you can do a will for managing estate taxes. How to appropriate the distribution to heirs. Oh, I've got 3 houses. One will go to my elder daughter, second will go to my younger daughter, whatever. You can do that. You can have power of attorney for medical decisions and financial decisions, and you can decide who and how will take care of you. So this is not complicated. It's just a bunch of paperwork which needs to be done. Well, that brings me end to my presentation. So questions? I think everybody's asleep.
Hi, Amit. This is Sandeep again.
Yeah.
I have a question regarding, the permanent residents who come in here and file taxes for the first time. I believe some of your overseas assets can be brought in without being taxed. So I don't know if you've already answered this question because I stepped out for a bit. Can you comment on this?
First of all,
yeah.
I might give you a little bit of an open-ended answer because I'm not qualified to answer this question. It's a CPA who is the right person. But I will try to help you lead into where you can ask a question to the CPA. So when you say overseas assets, that means you bring cash and it will be without tax, or what do you mean by overseas assets?
Let's say I have some property in India, and that's something that I eventually want to dissolve and bring it to Canada, like liquidate and bring to Canada. So how do I declare? I mean, what kind of questions should I be asking the CPA to bring that into Canada?
I think there are limits on it. Let's say if the property, I think
Amit,
there's
can I comment on that?
yeah, sure.
Yeah, so basically what happens when the day you immigrate, there is an option where you need to submit goods to follow document, and then you get a receipt from the CBSA officer, an office which says goods to follow. And in that, if you have declared that within 2 years of your coming on PR, if you're going to liquidate some assets and get the amount to Canada, and you have a receipt for that. At the time when you're getting the amount to Canada, there would be a question asked, but if you have a receipt of goods to follow document, then at that point of time, they do not go further in inquiry about the same. Now, after 2 years, if you have liquidated an asset in India and you're getting it in Canada, obviously when you liquidate an asset in India, you pay capital gain tax there, right? So you have to have the proper documentation of the capital gain tax paid in India. That's point number one. And point number two, Canada is going to only evaluate from the day you bought your PR, the cost of the property at that day and the day you sold the property. Like, for example, I have a property in India which was 4 lakhs in 1992, but I immigrated to Canada in 2006, and that property was costing at around 1 crore at that time. So Canada is not going to evaluate your capital gain from 4 lakhs. It's going to start evaluating from 1 crore. Now, today I sell the property for 3 crores. So we paid capital gain tax in India and we have proper documentation. And what we submit to the Canadian government here, they then evaluate that property as per the capital gain tax of 2 crores, because when you immigrated, the property was 1 crore costing. And based on that, they will evaluate a tax on that property, and then they compare what you paid to the Indian government. If you paid more to the Indian government, they will say, thank you very much, we do not need any tax, welcome to get the money in. But if you pay less to the Indian government, they will give you a proper accounting documentation in which they will explain the amount of tax you need to submit to the CRA. But they will give you an option to fight that too. And that does go 50-50% other ways also. But this is what the experience has been for many Canadians coming from India and selling the property.
I see. So Shailesh, the most important thing is, I think, is that really necessary to declare it at the CBSA when we first come in? Because that is only for the goods that we bring in, right? In terms of something like fixed assets like this.
See, it also combines that, suppose, for example, goods to follow evaluation can be the jewelry and can also be ancestral hand down coin collection. That also evaluates in that goods to follow. And also goods to follow is the amount of money you are expected to yourself to get in next 2 years. Now, in that goods to follow, it's a very, very vague documentation of sort is that if it is mentioned in that goods to follow and you have got the receipt from the CBSA officer, they follow that document which you had submitted.
I see. So even in terms of fixed assets, you're saying, not just
yeah. Yes. Okay. And also one thing more I would like to add here is that suppose you've not declared goods to follow and then you get the money, that there is an option in that part also that they do consider that within 2 years you will be, because it's a paradigm shift and you are moving from a country to a country. So they do consider for the fact that you are 2 years younger in Canada and you have certain big amount coming in, it becomes the discretion of the evaluation officer in CRA to exempt it or take it further on. That is one. And another thing which I would like to add here, that suppose you are in Canada and you own a property which is costing more than $100,000, please make sure you declare it in your taxes, so that there are no surprises coming in, that you liquidated that property and you bring in that money, you have all documentation in place, and then they see that you've not declared it in your tax filing, that you owned a property outside Canada which was costing more than $100,000. That complicates things, though there is always a solution to this, because this country is still in an infancy state to strengthen the rules. But again, because it's such a large gray area, some people do not get through with the exemption. Some people do get through with the exemption.
Okay. So declaring it in the taxes is the most important part also, I think, apart from if I miss it in the CBSA.
That is very essential. And also I would like to add here, just for information's sake, about taxes, if we are having a discussion here, like for example, you have bank accounts, demat accounts, mutual funds, and LICs and properties in your name in India, based on your Indian identity, which is Aadhaar card, which is called Indian ID number. Now, the day you are defined as an NRI, which is 182 days and more, then there would be an effect on that, on those all instruments based on that identity. That's point number one. Second, the moment you take the Canadian citizenship, that identity becomes invalid, and any instruments based on that identity becomes invalid till you go back and declare yourself as a foreigner, and or you have an OCI and you get hold of a Aadhaar card based on that OCI. But in that meantime, if you function anything in those accounts, anything based on those instruments, based on that expired identity, that is by law an illegal act. And both countries may or may not, or may not come back to bite you and also make you run around a lot for paperwork.
Okay, got it. Yeah.
Sorry, Amit, go ahead.
No, anyhow, Sailesh, I think you did a better job than what I could. I didn't have too much of idea about this topic, so thanks for chipping in. Yeah, I'm not an expert at this particular subject. Yeah.
Thanks, Sailesh. Is that Sailesh, right?
Yeah.
Okay, great. Thank you.
Any other questions, folks?
Amit, about the life insurance, so like you said, many people said I have the insurance from my office, and then for the individual one, and the same situation with me, like I have insurance with my company, and then that insurance cover almost like everything, like critical illness, you said, accidental insurance, optional life insurance, all those are there with extended health benefit, paramedicals, visions, dentals, everything.
Yeah.
So like you said, it's true, when I laid off or I switched my company, that needs to be renewed with the new company. The question is here, if I'm going for the individual life insurance, what should I take care of? Like, what should I look into that insurance? Do I need to only like accidental life insurance and critical insurance, or everything, whatever the included right now, like including paramedical, dentals, accidental, optional, critical for individual?
So let me go from easiest to hardest, okay?
Yeah.
First of all, your health and dental. It's best that you get it from the employer. And let's say if you switch jobs, or you are laid off, or you plan to get into your own business or whatever, right? Then there is a 30-day timeline, which is called a follow me. So that's a law. So basically you can take that insurance with you for the health and dental. Your premiums will change, okay, but you can have the same coverage what you are enjoying right now. your premium might be double because right now your employer is subsidizing it. Okay. But you can still have the follow me plan, so you can get the extended health and dental. Okay. Next thing is disability. Disability insurance, if you generally, we are all into the working class, like educated people. So we generally, we are employed in tier 1 organizations. So we have good disability insurances. Disability, it comprises of short-term disability and long-term disability. And most of them will have good insurance. And you want to, and generally disability insurance is needed when I have income. So when I retire, I don't need disability insurance. Let's say I might get laid off, or I plan to start my own incorporation. Right now, I'm a full-time employee in a tech industry, and later on, I want to incorporate myself. So there is a way where you can do a top-up for the disability. So what it allows you is, when something like this life event happens, the top-up cost is very minimal. It's like $10 to $15. Okay, again, going to the right kind of plan. But what it allows you is, one time it allows you to replace your income, like replace that plan, and now you will start paying the actual premiums when you are starting to have the proper coverage of that plan. So the top-up allows you to kind of have the safety net that if you lose your employer's disability coverage, you can have your own disability coverage, and that's where your actual premiums will start. Otherwise, you'll be just paying $10 or $15 a month to keep your coverage active as and when it is needed. Third thing is critical illness and life insurance. Critical illness and life insurance, you can, yes, your group employers will offer you, where they will say, oh, you can buy an optional insurance and it is pretty cheap as compared to when you buy yourself. The reason being, the average employee's tenure in a company is 4 to 5 years. So there are no claims on those plans. Like the claim percentage is very low, and that's why they are able to subsidize that cost significantly, because they know that the claims are very low. End of the day, insurance is the risk, sharing of risk. So they have low risk, so low cost. However, if you want to, what you should be doing is, it needs a needs analysis. So this will be different for everybody. What is your debt? What are your investments? What is your mortgage? And what you want to, like kids' education, all that stuff. So we need to do this needs analysis to determine what is an appropriate coverage for life insurance. Now, everybody's situation will be different. Somebody will say that, hey, me and my spouse work, and I want a life insurance which replaces my income, and it also provides that much of income that my spouse does not need to work if something happens to me. And that way I need a one lump sum payment, which if I can invest, then I will get my wife does not need to work for money. So everybody will have a different coverage. Somebody might say $500,000 is good for me. Somebody might say I need $2 million insurance. And that's where a need analysis comes into play, which will determine what amount of life insurance is adequate. Okay. And after that, obviously, the cash flow comes into play, how much you can afford and all that stuff. But first of all, to fix the coverage. And then, and when other than that, what you want to think is what kind of plan you are buying. If you're buying a term plan, is it convertible? Is it renewable? Some term plans only convert into whole life plans. Some term plans don't even convert. You need to buy a new plan every time it expires. So there are a lot of nitty-gritties into it, which you need to look into when you are going for insurance. Yeah. I hope I
Okay, so basically you are suggesting that to buy the individual insurance, you will look for the term plan, like how much coverage you want, like 500, 1 million according to your need, and then critical and disability insurance.
Yes.
Rest of the
Yes.
things like paramedical, health, all those will covered with your employer.
Yeah. Even disability, primarily it will be covered from your employer. What you are buying is just a top up. So your cost will be minimal, but you have a safety net that whenever you lose that coverage, you will jack it up with your own coverage. Okay.
Okay,
You are
yeah,
locking your age and health. Insurance is all about locking your age and health. Because today you are younger, you have less medical issues, you are easily insurable.
Right.
Slowly, as you age, your cost of insurance increases, and there might be exclusions because, oh, somebody has diabetes, or somebody has cholesterol, or somebody has a history in family of thyroid or something else, and that's where the exclusions start coming in. Okay. Yeah.
Okay. Yeah. Because before giving the insurance, they do need to check your health, how healthy
Exactly.
you are.
Yeah.
Okay. Understand.
Any more questions?
Any good companies you suggest to go for these insurances? 1, 2, 3, 4, 5.
There are quite a few companies in the industry.
Mhm.
The top 4 in the personal retail industry. So Canada Life is the largest company, but it does not offer any retail insurances. Okay. So other than that, you have Sun Life, Manulife, and IA Financial. These are the 3 largest companies. And then you have Equitable, then you have Empire Life. There are at least 15 to 20 different companies, but generally Sun Life, IA Financial, Manulife are having again, Manulife is more on the retail corporate side than retail side. Yeah, but again, it depends on what kind of plan you are buying. Because if you're buying a term plan, can it be extended? Can it be converted? Can it be renewed? Can it be renewed into a whole life plan, or it can be renewed into a universal life plan? What are the critical illness coverage? Those all things needs to be taken care of before we determine. So first comes the coverage and the type of the product, and then you go into the which company to buy. Okay, so don't go by the company. First go by your need. And yeah.
Amit, I already sent a direct message to you. I would need your help in gathering more information about estate planning, as well as will is another one which we already have in place, but something about estate planning regarding investment properties, as well as a few other investments. So I would take it offline with you for gathering more information on this.
Sure.
Thanks, man.
Definitely. Yeah. I think Amit Kumar, people have run out of questions.
Awesome. So that's great. It's a good thing to have. So if everybody's done, then thank you so much for taking this time, everybody, to come. And thank you so much, Amit, for doing this. It's really, really awesome. So yeah, if you guys have any more questions, I'm going to leave the WhatsApp group on for a couple more days. And then we can go from there. If you guys need any information, anything, let me know. Okay, and then you all directly reach out to Amit in the WhatsApp group, and we can see what needs to be done. We can try and answer your questions as much as we can. Okay.
And are you going to share the presentation with them?
Yes. So yeah, maybe you
I'll
have
send you the final copy. I will send you the
probably share that with the group in the group.
WhatsApp? Okay. I will share it in the WhatsApp group then. Yeah.
Sounds good. Thank you so much, everybody. Thanks for coming. Have a great day. And we'll try and share this recording and the PDF as soon as possible.
Great work, Amit. Very good informative session, and thanks, Amit, for arranging this. I would love to attend more sessions like these, because they're very fruitful information as well as good discussion during the session.
Yeah, and we are for the estate planning thing, Salish, right? We are actually in talk with a lawyer to arrange a session for this.
Yeah.
Awesome. I would love to attend that.
Yeah.
Awesome. Thank you, guys. Take care.
Thank you, Amit.
Thanks, everybody.
Thank you.
Hi, Amit.
Thank you.
Amit, I have one general question.
Actually for filing income tax, na? So we can do ourselves or somebody, can you advise somebody?
You
So
can
who
do
can
it
be
on
able
your
to
own.
help?
You can do it on your
Hmm.
own as well. It's not really that complicated, but I always suggest to go through an accountant. We have a couple of accountants in our group. So
Okay. Could you please advise, anybody if you knows?
sure, yeah. I will pass. Who is this? Who asked this?
Hari
Hari.
Krishna.
Okay, Hari. So I will share somebody's number with you.
Yeah, sure.
Amit,
Thank
can
you.
you
Thank
also
you very
share it
much.
with me as well?
Okay, sure. Who was the other?
This is Ajay.
Ajay. Okay, Ajay. Sure. I'll.
Thank you.
Okay.
Thank you, guys.